Hi, my name is Spencer Carenti. I run Alkaline Advisors, and today we are going to review our mixed use development financial model template. So, this will be probably about 20 minutes. I'm going to start by doing a brief overview of the individual tabs and how the model works, generally speaking, and then we'll dive a little deeper into the nuances behind each tab. So, to start, this is what we call a fully dynamic model, meaning that all of the inputs you'll have will be on these blue tabs. And then within each blue tab, you'll see blue cells. These are input cells. Everything else auto-populates based on what is put into these blue cells. And I would say 95% of the inputs are on this tab right here, titled the Inputs tab. This is what it looks like. Again, we're going to review this very quickly, brief overview of everything, and then we'll get into it deeper. Next, we have the cash flow tab. So you'll see the cash flow tab, it's separated by construction costs, it's compartmentalized. We have multifamily operating statement, commercial operating statement, which we could expand and you can see actually the nuances. And then we have the commercial operating statement, combined operating statement. So this is multi and commercial on top of each other. We have the draw schedule. So first we have equity, then pref if there is any. Then we have the construction loan. Then we have perm debt, operational reserves, sale value of the asset. And then finally, we break out our model into contributions and distributions. With this, it's segmented out into what you're spending for the actual cost of the asset. And then additionally, what operational shortfalls you have once the asset is underway. And then for the distributions, we have it broken out by distributions from operations and then distributions from a capital event like refi or disposition. Then all of that breaks down into the levered cash flow line item, which rolls up into the partnership returns tab, which looks like this. We'll get into it in a bit. Next, we have the commercial rent roll tab. For the commercial rent roll tab, this is where you're going to load in the tenants that you anticipate occupying the development initially. And then down here, you have second generation rent roll or market leasing assumptions. This is where you can update what the next generation of tenants and the generation thereafter, what their lease terms will look like according to the market. We have multifamily rent roll tab. This just has additional info into the rent roll. Annual cash flows. This is the monthly cash flows annualized. Investor summary. This is a 3-page PDF that gives a snapshot of the asset. So you'll start with the investment description. You have different metrics at different points in time. So untrended versus stabilized versus at refi versus at sale. Everything here auto-populates. You could see you have return metrics, unlevered, levered, pref equity, LP, GP, deal notes, charts, graphs, sources, uses. It all auto-populates. So this is the investor summary. Snapshot at stabilization versus sale. And then an annual summary down below. And you can just print this out and send this directly to whomever you'd like to share it with. Then we have a lender summary, similar concept, but more so catered towards the debt side. And then this last tab, it's a custom cash flow tab. We'll get into what this means in a minute. But with that, that's the brief overview to start. And now we're going to dive a little further in depth for those who want to actually understand how the model works, not just what it looks like. So to start, we'll go to the Inputs tab. As I mentioned before, the Inputs tab is compartmentalized and you'll see these black bars. So to start, we have project returns, then we have general project inputs, then the multifamily operating inputs, then the commercial operating inputs. Remember that the commercial rent roll itself is on this tab. Then we have the project level taxes and reserves, financing inputs, we have brief sensitivity analysis. And then because this is a development project, we have the budget inputs down here, and then we drop in SOFR. So if we go back up to the top, underneath the project returns, we have it broken out unlevered and levered returns at a project level, and then partnership returns. So this is what the GP stands to make and what the LP stands to make. And you'll notice if you update the inputs, these figures will update automatically. So you can see how each input impacts the return metrics at the different levels of the project. Again, we have general project info over here. We have project timing. So when are we going to sell the asset? All these other figures will auto-populate based on other inputs and assumptions in the model. We have the project start date. So essentially, when are we starting the analysis period? We are choosing how we're valuing the asset at both stabilization and at sale. You'll notice at stabilization, by the way, these text figures auto-populate, right? It says valuation at sale, month 120. If we change this to month 100, you'll notice this updates as well. So even the headers will update. So you'll notice the valuation at stabilization and sale is separated out by the multifamily component of the analysis and then the commercial component of the analysis. You can choose what NOI you're capturing to value the asset at both stabilization and at sale for both the multifamily and commercial components, whether it's forward 12 or in place. That's just for the stabilization, same thing, forward 12 or in place. For the sale, we have forward 12, trailing 12, or trailing 3. Same thing with this, forward 12, trailing 12, or trailing 3. And you can choose the specific cap rate for each of the specific asset types, whether it's multifamily or commercial. Next, we'll have the multifamily operating inputs. So this is the rent roll. Because this is development, again, you can break out units individually, or you can say there's X number of unit ones, there's Y number of unit twos, right? 1 bedrooms, studios, 3 bedrooms, however you'd like to do it. Then you can break out what the square footage of the unit type is. Again, we have the unit count next to it right here. And then we have the untrended lease up dollar per unit per month figure. So as of today, as of analysis start, what would these units be renting for if they were online today? And then, so that is untrended. And then we'll trend them based on the rent growth down here. And if you don't want to trend them during construction, you can zero these out, right? So we have the price per unit per month as it stands today, start of analysis. And then when are these units coming online? So essentially, when are you first generating revenue for these units? With these units, right, you're going to have a certain amount of units come online at the same time. That's going to be all the units that are pre-leased. So you can choose how many units are pre-leased for each unit type. And then finally, thereafter, the lease up start month, you can then choose how many units are leased per month thereafter. And depending on how many units are remaining to be leased after pre-lease, this lease up end month will auto calculate, and then it'll take the furthest month from the analysis start date, and that will be when lease up is complete. That will be at a multifamily level when you are stabilized. Then we have expenses. Expenses you can tie to the lease up of units or just the delivery of the product. You can choose individual growth percentages per each line item. You can choose the expense type. So are we calculating it dollar per unit per month, dollar per unit per year, or total amount per year? So right now you'll see this is dollar per unit per month, $10 per unit per month. If we toggle this to total per year, now it says $10 per year, and everything will update accordingly in the model. And we will straight line that across a given year. Management fee, you can tie to total rental income or just the total income. Reserves, we're just sweeping this out almost as expenses, total dollar per unit per year amount, or again, you can change it to per month or per total per year. And then we have growth factors and loss factors. So the growth is just rent growth, and the loss factors are loss to lease, vacancy loss, concessions, and other rent loss. Then we have other income. Similarly, you can tie it to lease up, delivery, dollar per unit per month, dollar per unit per year, just total amount per year, and you can choose the amount. Underneath, we have the commercial operating input. So what I'm going to do is after I get through this section, I'm going to jump to the commercial rent roll tab to finish off explaining the inputs for the commercial asset. So we have reimbursable expenses, we have non-reimbursable expenses, we have general market rent growth, vacancy loss, other rent loss. We'll get into this in more detail. We have other income, which again could be tied to total RSF, occupied RSF, income type, dollar per RSF per year or total per year. Then underneath we have the reserve section. So the reserve section here, same thing. We're kind of just sweeping it out as expenses. And then as it relates to project level reserves, this functions a little differently. Essentially, we're able to identify if there is any operating shortfall, how much is it? And then we can toggle if we want to sweep cash from operations, if we want to sweep cash from refi, if we want to sweep cash from both operations and refi to cover that shortfall. Or we can say, hey, we're just going to cover the shortfall with equity and we're going to cover that out of pocket rather than from a project level. And if we're covering it out of pocket, we can choose to incur that cost out of pocket and have equity come out of our pocket at the time it's incurred, or we can call for that upfront and say if we have an operating shortfall in month 12 of $100,000, we want to cover it in equity, we can just say, hey, we're going to raise an additional $100,000 in time zero or upfront. So that's the operating reserve section. So now I'm going to jump to the commercial rent roll tab. Here you'll see we've broken out, we can customize anything in the model, but we have, I believe it's 30 different tenant options. You can have more or less. Let us know, we'll customize it. But essentially, you'll build out the initial tenant you want to occupy the space. And it could be just market leasing assumptions, could be above or below, depends on how you have it structured. But you would choose, or you would list out the tenant name, the suite number, the size of the space, when the tenant is going to move in. So at what month is it going to be leased up? Again, this is development. So if you're finished, you can tie it to construction completion. You can tie it to construction completion plus a few month lag time, or you can just say, hey, we know the first tenant's going to move in month 24, or whatever that might look like. Then we have lease term. How long will this tenant be occupying the space? What is the rent per square foot per year figure? How frequently are we escalating the rent growth? So right now we have every 12 months, we can make it every 24, every 36, or every 60 months. What does that rent escalation look like? How many months of free rent, if any, is there? If we do 0, now it's 0 months. What is the tenant improvements per square foot? What are the leasing commissions per square foot? And then what do the recoveries look like? Are they triple net? Are they base year? Or are they gross? Similarly, we have very similar inputs for the second generation rent roll or market leasing assumptions. Here, though, we'll have a retention ratio. We'll have a downtime between the lease turns. Similarly, we'll have the lease term. We'll have market rent per square foot per year. We have annual growth, new free rent versus renew free rent, new tenant improvement PSF versus renew tenant improvement per square foot, new leasing commission versus renewal leasing commission, and then recoveries down here as well. So that is the commercial rent roll tab. I'll go back to the inputs tab now, and we'll jump down to project level taxes and reserves. Again, we went through the operating reserve section. Now we're going to go through the taxes section. We've built the tax section out in two different ways. We don't have any macros. We don't have any circular references in our models. But we do have the optionality to iterate calculations based off of goal seeking. So we explain what goal seeking is. I'll explain that now, but we'll also explain how to goal seek based off of our conditional formatting. So for instance, let's actually start with a simple version. We can hard code taxes. If we're hard coding taxes, you just input the annual tax amount, and then in year 6 plus, what is it going to grow at after year 5? Or we can use the goal seek functionality. So what this is saying is we are taking 1% of the value of the cost of the asset or the value of the asset, and then escalating it until the next time we're valuing the asset. So 1% of the post-construction tax basis, we're taking then 1% of the stabilized value, and then 1% of the sale value. Now, in order to calculate the stabilized and sale value, what we're doing is we're using a cap rate for the NOI. And because the NOI is revenues minus expenses and the line item for tax is part of the expense section, we need to know what the expense section is before we understand the value of the asset. But then we also need to understand the value of the asset to be able to say, okay, taxes are 1% of that value. So you see what we're doing is we're iterating the calculations until we're getting to a figure that tells us both, okay, we know the value of the asset, and based on that value of the asset, we know what the value of that tax line item is. And again, based off of the value of that tax line item, we know what the value of the asset is. So it goes it iterates. I don't think that was the best explanation, but reach out and I can give you a better one later. So essentially, right now this is accurate. If it was inaccurate, let's say we updated some formulas, right? We updated to sell in month 100. So now what will you see? You'll see this cell is red. because the value of the asset has changed because we're no longer selling it in month 120, we're selling it at month 100. We're using different 12-month NOI period. So you'll see this is red, and now we have this conditional formatting pop up. And essentially, it's telling you exactly what you need to do to update the goal seek correctly. So start with the yellow, goal seek instructions. Go to the ribbon bar. This is the ribbon bar. Go to data. Go to what if analysis. Go to goal seek. So that's the first section. Right now, tackle in order A, B, and C. So start with A. The set cell field should be set to the red cell on the left. So set cell to the red cell on the left. Perfect. To value what? Well, B. Field should be set to 0. So let's make that 0. By changing cell, right? C. The by changing cell field should be set to the blue cell on the left, right here. Now, if we press OK, we're iterating, and you'll see very quickly those numbers kind of moved in unison. And now it says target value 0 has been achieved. We've done that. It's iterated. Now we're able to understand what the value of the asset is and what the tax amount is if the taxable amount at sale is 1% of the value of the asset. So that is how we use the goal seek functionality. Next, we're going to drop down to the financing inputs. So the financing inputs are pretty straightforward. We have different levels of the capital stack. We have construction loan, we have pref equity, and then once we hit stabilization or once we want to pay off the construction loan, we'll go into the perm loan section. So starting with the construction loan is based off of the budget inputs. So essentially we'll load in all the budget inputs, and you can choose if something is financeable or non-financeable. Right now we have everything set to financeable. And based off of what all the inputs are summed together, that is what the total project cost is. Now, what we've done is we've broken out total financeable costs, which is everything in this budget input section, added up, that is toggled to financeable. And then we have total financeable costs with interest reserve. So we're building interest reserve into our model by, again, using a goal seek to calculate what the loan to cost would be inclusive of the interest reserve. And again, it's another example of where we have to iterate because we need to calculate what the loan to cost is on the total loan amount inclusive of interest reserve, and the interest is going to dictate that. And in order to understand what the interest is, we're going to have to understand what the total loan amount is. So it kind of goes back and forth and back and forth. But in essence, this is a construction loan. So first we're drawing down equity, then we'd be drawing down pref equity, or you can call this mezz debt as well, depending on what you have to add to your capital stack. And then finally, we're going to be drawing down on the construction loan. We're only going to pay interest on the amount of debt outstanding based off of when we're drawing our construction costs and based off of our spend curve for the construction budget, which we'll get into where those inputs are later. That's on the cash flow tab. But here you can choose what the loan to cost is, what the loan fee is. We can choose whether or not any cash flow at an operational level, once we are generating cash flow. So maybe the project is not yet stabilized. We still have the construction loan in place, but we haven't yet refied out of it, but we're still generating cash flow. We can choose whether or not we're using that excess cash flow to pay down what would be the accruing and compounding interest. So part of the interest is just paid current, or as much of it as we can is paid current until we refi. That's what this is. You can choose yes or no. Then we can choose if it's a fixed or floating loan. So if it's floating, it's tied to SOFR. So we have 500 points over SOFR. The SOFR curve is down here. You'll notice we just drop SOFR in directly from Chatham Financial. What's cool about this chart is that essentially we can choose when we last updated SOFR, when we dropped it in. And if you're actively running this model and you've incurred some costs to date, we can say that, let's say SOFR came out at 120. So that was 2 days ago. Now we move away from the future 1 month SOFR, and now we know actually what SOFR was, and we can update this. Now, if you don't update it, don't worry. We're still going to pick up what that future figure was. But as soon as there's something in this cell, this will override that. And you'll have the update SOFR alert come up to show you, hey, you need to update SOFR. Don't worry, we're still using the future 1 month SOFR from whenever you last pulled it. But if you want to use the most up-to-date information, update it, say you do, that disappears. So let's go now. We talked about the construction loan section. Let's talk about pref equity. Pref equity or mezz debt, you might have it, you might not. If you don't, we'll keep this toggled no. If you do have it, toggle yes. Now all the numbers will flow through correctly. You can choose the amount. It'll tell you what percent of the capital stack that is. You can choose if there are any upfront fees. You can then choose if there are any exit fees. You can then choose what the current pay is, if there is any. You can choose what the accrued interest rate is, if there is any. And you can choose if that interest rate is compounding or non-compounding. We can choose what percent of free cash flow are we using to pay this down. And ultimately, if there's a minimum equity multiple needed at the time of pay down or pay off, what is that amount? And if you can pay it off sooner, you can do so, right? So in essence, now there's no minimum equity multiple needed. If we have 1.17 is currently what we're at. So if we make this 1.2, for instance, we do have enough capital to pay it off. We're not quite at that 1.2 minimum equity multiple section or figure yet. So we need to pay an additional $90,000 whenever we're paying this off, and that'll bring us to that 1.2. And in this case, we'll see when we first draw in month 16 and when we pay off in month 30. So I'll toggle this back to, I'll keep this on for now, just so we can see how it flows through on the cash flow tab. Next, let's go to perm loan. So we are using the perm loan to pay off the construction loan, and when we can, to pay off the pref equity. Most of the time it will pay off the pref equity, but if you can't, the pref equity will be carried through until you either have sufficient cash flow to pay it down or you sell the asset. So perm loan. First of all, if you are developing and then selling, so merchant building, you can toggle no, and now we're using proceeds from sale to pay down the construction loan. Then let's say what we're going to do is use our refi, our perm loan, to pay off construction loan. We would turn this to yes. We would then choose what the loan to value is, based off of the value of the asset at refi. And again, to calculate the value of the asset at refi, we say it shows we're stabilized in month 29, but we want to refi in month 30. If we want to refi in month 28, well, we're using trailing 3 NOI. We're stabilized in month 29. So we actually aren't capturing enough NOI to pay down the construction loan, and you'll see these errors. So one error is the fact that we're refining before stabilization, and then the other is that we're actually unable to cover the construction loan by that amount. What's cool though is if we use forward 12, I'm assuming, we're able to pay the construction loan off, but you get an alert, hey, you're not able to, hey, you are refinancing before you're stabilized. So that is a neat feature here. Also, you'll notice right before there's this arrow, and then this thing, a cell shined yellow, and this arrow dropped down to the DSCR. What we've done is we've built out the functionality to size your loan, not only according to loan to value, but also according to either minimum debt service coverage ratio or min DSCR or minimum debt yield. So for this, you can see right now at a 70% LTV, at a valuation that we have, given that we're taking a 5 3/4 cap at month 30, using the trailing 3 NOI, we are at a 1.22 DSCR and we are at an 8.21 debt yield. But say the lender says, hey, we have a minimum DSCR of 1.25. Well, given these inputs and the values, we actually are unable to secure a 70% loan to value because our DSCR was too low. So now our DSCR is 1.25, but that's at a 68.5% LTV, not a 70% LTV. And you'll notice the loan amount has updated accordingly. So we auto size your takeout for you. Same thing with the debt yield, right? Say this is now 10, that'll drop down here, and they'll say, hey, you can only actually secure 57.5% LTV. So that's the perm loan section. Again, you can choose amortization, interest only, interest rate, loan fee. So next, let's talk about sensitivity analysis. For this model, we built out a 2-variable sensitivity analysis. Essentially, what we're saying is we are selling the asset in month 100, and we are selling it at in this scenario, we're using a 5.5 cap for the exit assumption. So now we're just assuming that we're exiting across both the retail and both the commercial and the multi NOI using a 5.5 cap. We're able to say, okay, the metric that we want to solve for, in this case, the limited partners IRR, is this figure. Well, let's actually do this. We actually give the functionality for you to solve for profit, IRR, equity multiple at both a project level, a GP level, and an LP level. So if we click LP profit, for instance, and by the way, you'll see this is red, this is yellow, that's good. We want that. That means that we need to do things before this is accurate. Same thing with this, input 100. So we need to make this 100, great. Now let's do this. If return cells red, update data tables. Go to formulas, calculate now. We go to calculate now. The model is iterating. And now we have an accurate sensitivity table. So we know at a project level, we are profiting 44.17 million. It shows at a project level, we are profiting 44.17 million. That is assuming we sell in month 100 at a 5.5 cap. Well, what if we sell at month 106 at a 5 cap? Well, our profit's going to be 56 million. What if we sell at month 94 at a 6 cap? Well, our profit's going to be 33 million. What if you want to show not 3-month increments, but you want to show 12-month increments? What if you want to show not 25 basis point increments, but you want to show 50 basis point increments? Well, here you make the spread 12 and you make the spread, let's do 0.5%. Oops. And now we will refresh. And this is what the information looks like. Your levered profit at a project level. Let's say you want to see what the LPIRR might look like. Same thing, calculate now. There you go. Okay, so this is the input sheet. And honestly, this is maybe 80% of the time that we're going to be spending running through this model. The next tab I want to show is the cash flow tab. So this one we won't spend too much time on now that we've already spent time going through it initially. But essentially it's broken out in these different sections as we showed: construction costs, operating statement, draw schedule. Now we have the Pref in there, so you'll see the Pref draws down, construction loan, perm, operational reserves, sale value, contributions, distributions, and then net levered cash flow. The only inputs on this tab relate to the construction cost section. You'll see if we go to land cost or soft cost or hard cost, let's open up hard cost for instance. Whatever we have in the budget will flow through here. So actually, let's open up soft costs because we had more soft costs. All that flows through. What we can do is choose what is the start month of those soft costs or hard costs. What is the end month and how are those costs allocated? Are they straight lined? If they're straight line, it's an even distribution across month X to month Y. Let's say it's not straight lined, but there's a moderate bell curve. Well, now you'll see we have a moderate bell curve. So the figures change. We start in month 1 at 4,000. We end in month 14 at 4,000. But right smack in the middle, we incur the highest amount of cost, which is 9,000. Right? It's just a way to estimate and to help us better understand when we're drawing the capital down, which will impact what interest is or what debt we have drawn, which will help us better understand how long the debt is outstanding, which will help us calculate the interest, and which will ultimately help us show the returns. So if we choose steep, again, now it's steep, and then we can toggle them and play with them as well. And that's just based off of the standard deviation. And then finally, what we can do is instead of bell curve, we can choose custom. And if this is custom, we can auto populate the costs. So I'll show you an example of that. We are financing the first generation tenant improvements and leasing commissions. We have them baked in as custom. So I guess in the sample, we haven't built anything out there. So let's actually just use soft costs. We'll do custom here, and immediately we're going to get an error, right? Now that's great. We want this error. Why do we want this error? Because it's not accurate as is. So what we need to do is we need to go to the custom cash flow tab. Now it says soft costs contains custom, right? So we need to open the soft costs, architectural and engineering. Notice none of the other ones are here. It's custom, right? We need to then allocate. How are we going to allocate this $3 million? Let's say we know we're going to spend $2 million in this month. Now we have $1 million remaining and we're going to spend another $1 million in this month. Great, allocation complete, remaining balance perfect, 0. We go back to cash flow, no more error, and that $2 million and $1 million flow accordingly. So that's the construction budget section. Next, I will go into the operating statement. So we've broken out, again, the multifamily operating statement in a lot of detail, and this is just for multifamily. You can see the lease-up schedule, the operating income. You can see other income, vacancy, concessions, rent loss, expenses, all the way down to NOI, less replacement reserves. Similarly, we have the same insight into commercial operating statement. So same thing, it's going to be detailed commercial operating statement so you can actually analyze what that looks like. But then what we've done is maybe you don't want to see so much detail on the multifamily and commercial level together, or maybe you do initially, but you just want a snapshot in the future. Well, you could just look at the combined operating statement. And this combines in these line items both the commercial and the multifamily. So next we have the draw schedule. This is pretty straightforward. We are starting with the partnership equity. So we'll get into the GP-LP splits in a moment, but first we draw equity down, then we draw Pref or Mez if we have it. In this case we do. We're going to draw it in month 16. And by the way, we're drawing and then we're paying back when we have the capital, right? So here we do have an exit fee based off of our assumptions. Here we do need to pay additional based off of the minimum equity multiple. And if you go to the levered, what is this? Yeah, so this is Refi. So at Refi, we have all the extra capital. We're able to pay down all of the outstanding obligations. Then we have construction loan, right? We're drawing down the construction loan once we run out of not only equity, but Pref equity. The construction loan, you'll see we're accruing the loan fee. We have interest owed in a given period. Now it's being accrued and adding to the principal balance. And then finally in month 27, we are now, actually we can start in month. We have revenues that are being generated. We said that we want to sweep some of those revenues, any revenues, instead of making distributions to investors. We want to pay off the interest as we can. So we're paying down this interest current and only accruing whatever else is outstanding. And you will see that happens until month 27, which now we have enough cash flow, surplus cash flow to cover the interest that would ordinarily be accruing. So now there is no interest accruing anymore. It's just being paid current, and we are then reserving the rest. And that is the construction loan section. Next, we have the perm loan. And for perm loan, it's coming in when we say we want to refi. We're using proceeds to pay off whatever remaining balance of the construction loan we have. And then remaining proceeds are being distributed to the partnership. So next we have the operational reserve section here. You'll see we have some shortfall. Next we have the sale month. Sale month is kicking in month 100. And in month 100, you'll see we're selling the asset. And in return, we are paying off anything outstanding for the perm loan value. Then, as I said before, we have it broken out into contributions and distributions in terms of what we're paying and what we're receiving at what time. But everything that we've shown here, it'll all flow into the net levered and net unlevered return line items. The net levered cash flow line item, this is what flows into the partnership return section. Gosh, I do realize this is now a pretty long video. So if you're still with me, I appreciate it. I hope this is helpful. I'll try to speed it up a bit. Partnership returns section, we have GP-LP. You can choose what percent of the equity the GP is bringing. The LP will bring the remaining balance. You can choose what the splits are between GP-LP. If it's pari passu, you can say no hurdles. If there's a pref, you can choose what that pref rate is and then whatever the promote to the GP would be. Or if you don't want to promote and you just say, hey, I just want a 20-80 split after that 8% pref is hit, well, we can do that too by just toggling split. If you want multiple hurdles, you can toggle this to multiple hurdles. Then we can choose the compounding frequency as it relates to the pref. So is it compounding annually or monthly or no compounding? Distribution frequency, are we making distributions monthly, annually, quarterly to our investor, to the LP? And then equity, are we contributing it upfront or are we just contributing it when it's incurred at a project level? So, for instance, if we toggle these three, you'll also see we hit tier 1, we hit tier 2, tier 3 does not hit. Why? Because we say at an 18% IRR to the LP, the GP will receive 40% promote. Well, if you notice, the LP is actually at a 16.5% IRR. If we make this 16%, it still doesn't hit because the LP is only achieving that 15.4% based off of monthly compounding. I think if we change this to no compounding, then it'll hit, right? Perfect. And next we will go to and then you'll see the GP returns here. Again, we have brief multifamily rent roll overview. It's just, right, we've broken it out by untrended rent roll, trended rent roll, lease up schedule, market rent per unit, total market rent. And you can see how that looks broken out in more detail. Then we have the annual cash flow. The annual cash flow, it's the monthly snapshot, but annualized. Then we have the investor summary. The investor summary, again, has investment description. We have snapshot at different periods, untrended, stabilized, refi, sale, broken out. You see revenues, expenses, NOI, development spread, costs, yield on cost, cap rates, development spread, cash on cash, DSCR, debt yield, deal notes. All of this will auto-populate. Metrics and returns, unlevered, levered, Pref, LP, GP. Remember, this was blank before because we had Pref turned off. If we turn it on, then the numbers will auto-populate. Sources and uses, update automatically. Same thing with the charts, same thing with the graphs. What's pretty cool also about the graphs, yes, they update automatically, but you'll notice these match identical, which you would think is normal because it is. That being said, right now we're saying we're incurring the equity when it is needed. So whenever there's a cost. However, if we raise all the equity up front, now what we're saying back on the investor summary is we are front loading that equity. So all that LP equity is going to show up front. And this is the capital that's going to be required up front. This is the capital that's required when it is needed based off of cost and when we're drawing things down. Same thing, we have notes, sensitivities, we have operating statement, annual summaries, snapshot of operations, and then we have our lender summary, which we'd mentioned before, debt request, cash flows, sources and uses. Pretty straightforward. We're going to put this on our website. If you're seeing this and still here, thank you. I appreciate your time. We've got some confetti. Look at that. But we're going to have a PDF download. Feel free to download it. It'll be this model just in PDF format. And then if you have any questions, reach out. Happy to answer them. If you want customization, reach out. Happy to talk through what that might look like. Yeah, we really hope this was helpful. Thanks again for your time. And we are here if anything comes up. Once again, my name is Spencer Crenti. I run Alkaline Advisors, and thank you.